Hey, what's up everyone? My name is Scott and welcome to my channel where I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. In today's video, we're going to talk about earnings and specifically, in my opinion, the best way to trade options on earnings announcements. And so the reason why I'm making this video is because we are now in full swing of Q2 earnings season. Every earnings season starts off with the big banks going first. So last week, for example, we saw Goldman Sachs, JP Morgan, Morgan Stanley, Wells Fargo, etc. all report their earnings. And now we're moving into the bulk of the Q2 earnings season where more exciting companies are going to start reporting like Apple, Google, Netflix, Snapchat, Facebook, etc. And ultimately, earnings are my favorite time to be active in the markets and selling options specifically because of one major thing, and that is implied volatility. Now, for those of you who are not too familiar with that concept, I'll explain it very simply here. Implied volatility is just the measure of fear or uncertainty about a company's future. And more technically speaking, it actually allows you to quantify a price range, an expected price range, I should say, for that company's stock at some point in the future. And so this level of fear or uncertainty can grow and shrink on a daily basis, which causes the expected price ranges at some point in the future, could be a day, a week, 6 months, or a year, anytime in the future, it causes those expected price ranges to grow and shrink as well. And hopefully this should be a little bit intuitive because when you think about it, if there's more uncertainty about a company's future, and if we're going to try and make some sort of accurate prediction about where the stock price is going to be, let's say 6 months from now, we're going to need a very wide price range because it could be anywhere within that range. We have no idea. But on the flip side, if we're a lot more confident and certain about where this company is going, then we can have a much more narrow expected price range of where the stock is going to be 6 months from now or a year from now. So that's implied volatility. It is just a measure of fear or uncertainty that can also allow you to calculate an expected price range at some point in the future. And the key thing to keep in mind here is that implied volatility is used to price option contracts. And specifically, as the level of uncertainty, as implied volatility expands, that's going to increase the prices of options. And then conversely, as the uncertainty goes away, as people calm down and become more certain about the future, then implied volatility contracts and the prices of options come down. So now what does all this have to do with earnings? Well, as you get closer and closer to the earnings announcement date, there's going to be a buildup of more uncertainty about those earnings figures, about the performance of the company over the past quarter. And so as this buildup of uncertainty and suspense increases, the prices of options for that company are going to start increasing as well. And that's what's going to make it very advantageous or very attractive for an option seller like myself to come in and start selling those option contracts, right? Because as a seller of anything, you always want to sell that thing for the highest price possible. And then potentially later down the road, you can buy that thing back for a much lower price and make the difference as profit. And so that's how it works with selling options around earnings announcements. You have an increase or expansion of uncertainty and implied volatility leading up to the announcement, causing option prices to increase. That's when you sell them. And then once those earnings figures come out, and once everybody knows what's going on with the company and all uncertainty goes out the window, we have the figures now, then implied volatility will typically get crushed, causing the prices of options to get crushed along with it. And therefore, that allows you to buy those option contracts back for that much lower price, and then you make the difference as your profit. And so with all that being said, I just kind of wanted to lay the foundation here first. And at this point, we're going to jump on over to my computer now, and we'll dive into this topic in a lot more detail. Okay, so as always, before we fully dive in here, I do want to give a brief announcement to any of you who are new to the channel, and that is you can also find me on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing, and I provided some links to some of the introductory courses of mine in the description of this video below, so be sure to check them out, and when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. Okay, so in order to demonstrate how all this is going to work, the stock I'm going to use for my examples is going to be Pinterest. So what I have pulled up is just a 1-year price action chart of Pinterest stock. And down here, you can see another chart that shows the implied volatility for this company or for this stock also over the past 1 year. Now keep in mind, like I said, implied volatility is a measurement. Based on the level of uncertainty about this company's future, it allows you to quantify the expected price range for the stock at any point in the future. So you can see right now the level of implied volatility for Pinterest is at 66.89%. Implied volatility is always a percentage. And also by default, when you look it up in your trading platform, the timeline in the future that it's looking at is always 1 year in the future. So basically putting this all together, what this means as of right now, at the current level of implied volatility, the whole market, if you will, is projecting Pinterest stock to be either up or down by 66.89% 1 year from today. And then, of course, as you can see, the level of implied volatility, the expected 1 year price range of the stock can fluctuate quite wildly on a day-to-day basis, right? So as a second example, at this point, which was on January 27th, 2021, at this point in time, the market was projecting Pinterest stock to be either up or down by around 100% 1 year in the future from this point in time. So basically by January 27th of 2022, the market was expecting this stock to be either up or down by about 100%. That's a very big move, a very big expected price range. And notice when this huge expansion of implied volatility, this huge expansion of uncertainty happened. It happened right before an earnings announcement. That's what these dots mean on the chart. These all indicate earnings announcements. And so if you compare each earnings announcement to where implied volatility was beforehand, you'll notice every single time leading up to the earnings announcement, there was a huge expansion of implied volatility, a big expansion of uncertainty. Everyone's eager to know how this company performed over the previous quarter. And then finally, once those figures came out, once they were announced, boom, a huge collapse in implied volatility, a huge collapse in that uncertainty. Now everyone knows. Pinterest revenue was this, their profits were that, their market share increased or decreased by this amount, etc., etc. Once everyone knows exactly how this company did, there's no more uncertainty, or at least there's a lot less. And you can perform this same analysis on pretty much any stock that you want. And you'll notice that the vast majority of the time leading up to the earnings announcement date, implied volatility will expand. And then once those figures are announced, you will almost always see a very significant contraction of implied volatility thereafter. This does not happen every single time, but it does happen the vast majority of the time. And that's what matters. And so once again over here, what's happening? We're seeing an expansion of implied volatility, and Pinterest will announce their next earnings figures on July 29th, which is only about 2 weeks away. So I would expect for the next 2 weeks, we'll see implied volatility, we'll see uncertainty expand even further. And then come the market open after the July 29th announcement, I guarantee we'll see a very huge crush of implied volatility. So now finally, in terms of actually trading options on these earnings announcements, what do I, for example, do in these situations? Well, it all comes down to option selling strategies. And so the first thing I will look at before I make a trade on an earnings announcement is I'll come to the trade tab and I'll look at the expected 1 day move. And you'll see that 1 day expected move pop up in your trading platform right here. Now, unfortunately, because Pinterest earnings are still 2 weeks away, it's not popping up here yet. But if we go to Intel, for example, INTC, there you go. Now you can see it because Intel has earnings in just a few days. I'm not sure why ThinkOrSwim only built this in or why they only have this pop up when there's a big expansion of implied volatility, typically right before an earnings announcement. I wish it was here all the time. But just note in ThinkOrSwim, this 1 day expected move will pop up a few days prior to earnings. So in the case of Intel here, you can see the expected 1 day move is plus or minus, up or down basically, $2.74. And this expected move, this expected price range basically, is based on the implied volatility of the stock, right? Because like I explained, implied volatility allows you to calculate an expected price range at any point in the future, either a full year or just 1 single day. So in the case of Pinterest, let's go back. Let's just pretend here for a moment. Let's fast forward time 2 weeks. And today is July 29th, 2021. And the market is going to close in 10 minutes. And once the market closes, that's when Pinterest is going to release all their earnings figures. So at that point, I would come into my trade tab here. I would look at the 1 day expected move, which would pop up. And let's say it's plus or minus $8. That's the expected move once those earnings figures come out. So then what I would do is I would go into one of these expiration cycles and sell both a call option and a put option, a strangle essentially. and I would choose strikes that were either at or beyond the expected price move. Now, which expiration cycle would I choose? I prefer to be a little bit on the safer side, and so I prefer to choose an expiration cycle with a decent amount of time left to go. So if today was July 29th, this September expiration cycle would have about 40 something days left to go, and this would be the expiration cycle I would choose. You can also definitely sell options in nearer term expiration cycles, and I'll talk about the pros and cons of that in a minute. But like I said, for me personally, I like to stick with expiration cycles with a bit more time left to go, at least 30 days. So again, assuming today is July 29th, and assuming the stock price right before the market closes is $70 per share, then if the expected move is either up or down by $8, that means I would want to sell a call option with a strike of at least 78, and then a put option with a strike of at most 62. Now, as you can see, there are no strikes for 78 exactly or for 62 exactly, so I can kind of get pretty close and choose the 62.5 strike put option and then choose the 77.5 strike call option. And if I go ahead and set up this order here as an example, go to sell, strangle, let me scroll down. So 77.5 strike call option and then the 62.5 strike put option, there we go. And you could see I could sell this one strangle for over $600 in credit. That's really high considering this is only a $70 stock. And once again, the reason why these options are so expensive even today, which at the time I'm recording this is only July 17th, is because implied volatility is expanding. So it definitely pays to be patient and wait for the right time to take advantage of high implied volatility. Let's come back. And so why exactly would I want to do this? I've already shown you that implied volatility almost all the time contracts after the earnings figures come out, and that will definitely work in your favor as an option seller. But what about the actual stock move? Who cares if implied volatility contracts if the stock goes from 70 to 90, well beyond the expected move? No amount of implied volatility contraction can save you from that kind of extreme price move of the actual stock. Now, of course, that could happen. There is always risk in the market, but it's very, very unlikely. The odds are actually overwhelmingly in favor of the stock actually moving less than what is expected. So if the expected move is either up or down by $8, what you'll find most of the time is that the actual move, once those figures do come out, might be the stock goes up by $5 or down by $3. And the reason behind this has to do with the fact that one of the characteristics of implied volatility is that most of the time it's overstated. There is more fear, more uncertainty about a stock's future than is actually necessary, than is actually justified. And so ultimately, when you translate that overhyped fear or uncertainty into an actual expected price move, what you'll find most of the time is that expected price move is overstated or that it's greater than it should be. So in the end here, if I did decide to sell these option contracts, and then let's say the actual move of this stock was Pinterest went up by $5, well within the expected price range, you are basically guaranteed to see a huge collapse in implied volatility. All that uncertainty goes out the window, and as a result, you'll see the price of the strangle come down dramatically, maybe from 600 down to 300. And at that point, you could buy both these contracts back and make a $300 profit just in one day. And that's the beauty of selling options right before earnings announcements. You take advantage of this increasing level of implied volatility and uncertainty right before the announcement, and you sell options right here when those contracts are the most expensive. And then most of the time, the stock will move less than what's expected, which will cause implied volatility to collapse along with the prices of those options you sold, which finally in the end allows you to buy them back at a much lower price and walk away with a profit. Now, what if the stock actually moves beyond than what is expected? Let's say Pinterest actually moves up by $10 or $12 and it breaches my call strike. And so it's because of situations like this, because yes, sometimes the stock will move beyond what is expected. And that's why I prefer to choose to select my strikes a bit beyond the expected move. So I personally would not choose these two strikes. I might instead choose the 80 strike call option, or maybe even the 85 strike call option if I was pretty worried about the upside. And then same thing for the put, I would choose probably the 60 strike put option, or maybe even the 57.5. So for the sake of example, let's say I went with the 80 strike call option and the 60 strike put option. That means I will collect less credit on the strangle, but that's fine with me. So the 80 strike call option is here, and then the 60 strike put option is right there. So the credit now falls down to $486. That's still totally fine with me. And now I've given myself more cushion in the case that this stock actually does move beyond what is expected. And in the majority of cases where it doesn't, I'll still make a pretty nice profit here, right? Again, if perhaps Pinterest only moves up by a few dollars once those figures come out, the price of the strangle might get cut in half. And if in those very rare cases where the stock just explodes either to the upside or the downside, then in those situations, you're going to want to have very good mechanics, basically a concrete game plan to adjust or hedge your position. And that could be simply, instead of selling a strangle with naked options, you could do an iron condor with defined risk. You could also just sell one side, just a put option or just a call option. For me, because I pretty much only sell naked options, I would either buy or short shares of stock as my hedge. Or you could roll this whole strangle out in time to the next expiration cycle to give yourself more time and to also collect more credit. There's a bunch of different ways to hedge or protect yourself if in those very rare cases where the stock actually just explodes. But in my experience, that does rarely happen. Earnings trades are still my best kind of trades. Now, finally here, the one last thing I want to mention is in regards to the expiration cycle you want to choose. As I explained, for me, I like to go a bit further out in time to give myself more cushion in my strike selection while still also collecting a pretty decent credit. But if you want to sell option contracts that are much more sensitive to a contraction of implied volatility, then you're going to want to sell much more shorter term expiration cycles. The further out in time you go, the less sensitive those contracts are going to be to a contraction of implied volatility. So in a case like this, with a huge collapse of implied volatility, you might see the prices of the option contracts in the September cycle drop by 30%, 40%, maybe 50% at the most. But in these July or August expiration cycles, you might see the prices of these options drop by 80% or 90%. Now, you also won't be able to sell these options for the same amount of credit as these options in September. And that's because options with more time baked in are always going to have higher prices. So it's up to you to decide which trade-off is best for you. Do you want to sell options for less in credit, but will have a much greater sensitivity to that crush in implied volatility? Or do you want to sell options with more time for a greater credit, knowing that they're not going to be as sensitive to a contraction of implied volatility? So you might have to hold these options for more time after those earnings come out to reach your profit target. And so with all that being said, that's going to wrap it up for this video. I hope you enjoyed it. And please let me know your thoughts or if you got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.